Connecting. All right. Good morning, good afternoon to everyone who is joining us today. Welcome, welcome. We are really excited to have a session for you. I'm going to quickly share my screen so you can all see what I'm looking at. Oh, hold on. This is the back end piece of everything. So welcome. As you are all trickling in, please feel free to introduce yourselves in the chat. We always love to see who's in the room with us. It's always great to have that interconnection. Again, as you trickle in, your name, where you're from. It's always great to see who's with us. And share sound. So we'll get started in about a minute. But again, welcome to everyone who is joining. We are excited to have you with us and have our session today around building different fund structures. We'll give about 30 more seconds and we will get started with quick housekeeping, and I'll hand it over. All right, we have 40 people in. Again, as you are all coming in, please yourself, where you're from, what you do. Always look to make sure that you have an opportunity to network and all right, so welcome to our event for today. Welcome from Allraise. Again, for those of you who are trickling in, please use the chat function to introduce yourselves. I am Brianne Kimmel and I support Allraise events here. So excited to have you all. And as some of you may know, we are a nonprofit dedicated to amplifying female voices, accelerating female success, and creating a tech culture where women are leading, shaping, and funding the future. Our events and the volunteers who make them possible are key to building and amplifying the movement. And so we just really quickly want to say thank you to our partners, such a big part of the work that we do. And we want to make sure that they get acknowledged. So thank you to all of them and our volunteers. Before we get started, I have a few housekeeping items. So I want to point out a few things about the webinar. You can use the chat function again to introduce yourselves and others on the call. If you do have questions during the panel today, there is a Q&A box. Please put your questions in that box. Myself and Sia will be on top of it to see what questions come in. And this session will be recorded today and will be up on our website within 48 hours. So make sure to keep an eye out on that. And we'll also send out a follow-up email letting you know when it is published. So we're really excited for that. And I think that is all. So welcome, welcome everyone. I'll hand it over to Sia from here.
Awesome, thanks so much. Hi everyone, thanks for joining the session. Before we get started, first of all, I wanted to do a quick shout out for Marianne for making this event possible. She did a lot of work behind the scenes to assemble everything and is very much appreciated. Thanks, Marianne. So let's get started. To give you a bit of background, I'm the GP of Pathway Ventures, an early stage fund focused on the human side of the future of work. My co-founder Taylor and I began raising this fund about 4 months ago, and after building a career as operators. So both of us had worked in VC before, but kind of navigating the different structures as we got started with Pathway was very confusing. And we realized a lot of our other friends who are also building funds right now were experiencing the same kind of confusion. So that's why I feel that today's session is actually really important. We have assembled a great panel of investors who are deeply knowledgeable about the different structures. And so through the conversation today, we'll dive into like the pros and cons of each structure and also provide advice on other people who are starting funds right now or just starting their investing careers. We have some questions, so we'll go through them first and then leave the last about 15 minutes for any audience Q&A. So anything that comes up, feel free to drop it in chat and Marianne and I will be tracking those. Cool, so we'll get started with the questions then. Would love to hear from all three of the panelists on how they got started in their investing career. Ashley, would you like to kick it off?
Yep, sure. Hi, everyone. Ashley here. I'm actually not a full-time investor. When I'm not angel investing, I'm a general counsel and partner at a real estate finance fund in South Florida with about $3 billion of assets under management. focused on lending and investment on large scale pre-construction and construction phase real estate projects. I started kind of in this world, I guess just over 2 years ago. And it was kind of a, if there's a will, if there's a way type of situation. I don't have a tech background, as I obviously alluded to, being a general counsel. I have a JD. Didn't come into it with kind of contacts in this world, and kind of was doing a disparate thing with real estate, but kind of had always been intrigued with the idea of venture and startups, and was determined to get started. So I kind of started using the AngelList platform actually, and happy to dive into that later as how that could be a mechanism to get started if you haven't worked in tech or kind of have this ready-made Rolodex of how to break in. How that can be a useful tool. But I kind of started investing via AngelList. And then as I kind of got more and more comfortable, that graduated into attending accelerators and demo days. I started meeting people on the platform. I got more comfortable at kind of my strengths and value adds to companies, started outreach. And then all of that kind of, my own kind of personal flywheel escalated into me starting a syndicate, also using the AngelList platform as my back office about 6 or 7 months ago. Was able to grow that syndicate to about 900 members, and have closed about 20 deals via that syndicate, ranging from pre-seed to my last closed deal was a Series C for a company called Style Seed. And so, yeah, it's just been a tremendous journey, and that's kind of where I am. And then along the way, and also happy to talk about that, have also taken advantage of some different communities and education, such as I did First Round Capital's Angel Track Fellowship, and also On Deck's Angel Fellowship, which is associated with Village Global.
Awesome. Thanks, Ashley. Bo?
Hi, I'm Bo. I also have a fairly non-linear background when it comes to tech and venture. I decided to drop out of law school and join a solar startup. I have a liberal arts background. So for me, it's been kind of a circuitous path into cracking into product management as a liberal arts background person who studied behavioral science. I built consumer content creation tools for Facebook, Instagram, and Tumblr. And then I made my way into product advising through the course of writing about product management, behavioral science, career pathing, etc. And naturally, decided to start angel investing in the types of underestimated founders who came from nonlinear, untraditional backgrounds as an angel. And also started consulting for a venture studio called New Lab, which gave me an introduction into the world of kind of hybrid investment vehicles as well as innovation arms. And that's kind of how I landed at Samsung next. I help with our deep tech investing theses around AI, edge computing, as well as building our ecosystem of deep tech founders to create strategic investment opportunities, collaborations, partnerships with Samsung Electronics. Our mandate is to kind of marry the software ecosystem with the hardware ecosystem within Samsung. On the side, I continue to focus more on consumer-driven angel investments around anything that has to do with ed tech, future of work, responsible technology. I have a deep soft spot for the responsible AI world, and super excited to be here. I kind of developed a angel community through the course of the years by bringing product leaders into angel group called the Product Leader Angel Group through the Product Leadership Summit that Ha Nguyen hosts. And we've kind of grown into a group of 50 people who are writing individual checks and sharing deals, as well as I work with Jenny Fielding's angel group called Coffee and Cap Tables, which is a group of New York angels that meet on a monthly basis.
Thanks, Bo. Brianne?
Hi, everyone. Thanks so much for joining today. I'm Brianne Kimmel. I'm the founder of Worklife. We're an early stage fund focused on work. My path into investing was an interesting one. I actually studied journalism, decided that I liked building websites more than I liked covering the news. And so I had, primarily been a product manager at a number of different tech companies. Had spent some time at Zendesk focused on our self-serve side of the business. And so I love looking at workplace productivity, SaaS companies that start more bottoms up. I got increasingly really excited about the consumerization of enterprise and what that means for the future of work. And so I had been angel investing on evenings and weekends, was an early angel investor in a company called Webflow, was also an investor in Lunch Club, which is basically unbundling LinkedIn and creating new ways for people to meet each other, now fully remotely during COVID. And so I decided to leave Zendesk, raise some outside money, and had gone a non-traditional route where I ended up raising from sector-aligned CEOs that had previously built really great companies in the category. And so that included Eric from Zoom and Stuart from Slack and about 40 growth stage founders, all under this category of consumerization of enterprise and sort of the future of the creator economy. And so my investors are the founders of Cameo, Twitch, Spotify, YouTube, and I've naturally been more of a community builder throughout my career. I started out teaching classes at General Assembly when I was early career. I then took that curriculum and built a program called SaaS School, which was behind the scenes a great way to really find ways to work with friends that were working at other SaaS companies. And so what's awesome about venture and why I got into angel investing from the first place is it's a great way to build a network and to find ways to collaborate with people at different companies. I also found that in starting the firm, it's really enabled us to create a lot of interesting programs for founders where you can pull in the early builders of the last generation of great companies to really find ways to be helpful and give awesome operators a platform and a microphone for them to really build their personal brand and to help the next generation of great companies. And so, I ended up raising a $10 million debut fund in October of 2019. And so I'm excited to answer any questions around, what that process is like and how to make the transition from primarily an angel investor on evenings and weekends to a full-time fund manager.
Great, thanks so much. And thanks all of three of you for joining us today. Before we dive into the questions, Marian will be sharing a poll for all the attendees, so you can kind of indicate where you are in your journey so far, and we'll cater the questions accordingly. So please fill that out.
Yes, we'll give you guys 30 seconds to fill that out. We'd just love to see who's in the room so we can really cater to the audience who's here. And we'll close it out in 5, 4. Thank you for all of those who are taking it. 3, 2, and 1. All right, and I'm going to share the results really quickly with everyone. So everyone should be able to see this. We have 23% emerging managers, 7% operators, 28% raising their first fund, 13% investors, aspiring managers, again, 23%, and students, 7%. So I hope that's helpful to our speakers today.
Perfect. Thanks so much, Marian. Awesome. So for the panelists, it seems like all three of you took rather non-traditional routes to get into venture. That's especially interesting given how the market is right now. Good founders have lots of different options when selecting who to add on their cap table. And I would love to understand how you went about building the brand and network that let you get into these really good deals when you didn't come from a venture background. So Brianne, would you like to kick us off?
Yeah, sure. Yeah, I can kick it off. So I would say right now we're seeing a lot of interesting trends. I think venture is going through its own period of disruption right now, and a lot of that can be attributed to the fact that platforms like AngelList and Carta are making it very easy to set up your own fund. I think about this a lot from the perspective of just the amount of time that's saved in working with a lot of these platforms to really get started. What historically would take a lot of time meeting with lawyers and accountants, and fund formation in itself was quite a dated practice. And so it's great to see that now from software standpoint, there are ways for individuals and especially busy operators to start their own fund either as a side project, or in my case, I actually scaled into doing it full time. What's interesting from a network standpoint, venture is an interesting industry where I find that every connection that you've made previously immediately becomes relevant. And so whether that's your previous coworkers, whether that's mentors that you've had along the way, I increasingly think it's interesting that the fact that I have both big company experience and early stage startup experience is helpful, because you can have that balance of understanding, what an enterprise sale looks like internally inside of a company, and you also get the sense for, some of the challenges that happen when you're building an early stage startup. And so, I talk to a lot of emerging managers, and one of the areas that I oftentimes encourage new managers is to really figure out what is your strike zone and where do you have a competitive advantage over other emerging funds or even super angels. And so, oftentimes that can come down to a few different buckets. For Worklife in particular, we went very deep on sector specialization. And so all our network, so my investors, the operators that we spend time with, the types of companies we invest in, like they all have a very consistent DNA across the board. And so, that's structurally helpful, where it's created a mutually beneficial ecosystem. That's also just one way of doing it. When I was building out the firm, in a lot of ways, I looked at Forerunner and Ribbit and a lot of specialized firms and said, if they were able to do that for direct to consumer brands in the case of Forerunner, or for Ribbit for fintech, it made sense to do this for enterprise and for tools that start more bottoms up or sell directly to developers, just because that go to market is so specific, and the questions that we're able to help with and the network that we've built is really relevant. I also find, for angels that are just getting started, starting with your first degree connections and the people that you work with on a day-to-day basis are a great way to get started. I really love the new alumni syndicates that are spinning up. Like, I co-invest with the Airbnb alumni syndicate a lot. The Pinterest Pin Angels are a great group as well. And so I find oftentimes picking the right high growth startup, or as I say, joining the rocket ship to learn how to build one, is a really effective strategy, where in a lot of ways, the people that you're working with on a daily basis, you already have trusted relationships, you already have access to that specific network. And so that can be a great way to build a track record, is through alumni syndicates or investing in great people that are leaving the startup that you're currently working at. The third thing is I actually found what was interesting as an angel is, tech is an awesome ecosystem because everyone aspires to be helpful. And I think especially angel investors, like everyone looks to figure out how can you deliver immediate value to companies to earn an allocation. And so I found in meeting companies, like through the program that I had built, SaaS School, I was meeting a lot of companies, and at that time I didn't have any capital. And so sending companies to VC firms and building a lot of those relationships really created a solid foundation, where the more you give to the ecosystem, eventually that will come back. And so I found in a lot of ways, I spent close to 6 years giving before I ever went out to raise money. And so a lot of those community activations, or sending companies to other angels, or catching up with other VCs, was really helpful before I ever made the ask. And so I find just giving to the ecosystem and building community can be really effective as well.
And SaaS School was a great way for you to meet all of these startups, some of which you ended up investing in later, right?
Yeah, it's exactly right. I mean, I would say that SaaS School came out of a desire to scale my time more effectively. When you're operating inside of a high growth company, one of the challenges is that you get a lot of requests for coffee, and you do want to be helpful, but it's really important to scale your time. And so in building SaaS School, and in both connecting, executives in my network with early stage companies and meeting a lot of early stage companies, what was interesting is that through the program, I had met Webflow, Netlify, Superhuman, Notion. A lot of companies came through the program, but at that time I didn't have any money. And so what was interesting is a lot of the people that I met through the program early on, after the first few times running it, many of them are now my LPs. And so it was great to just kind of lay that foundation and build a lot of relationships without any sort of asks. Like the goal has always been to just bring great people together and do more comprehensive and focused learning, as opposed to, like we don't take YC level equity or ask for any equity at all. We just do it as a community builder. And I found that was a great way to get started.
Thanks, Brianne. Bo, you have written so much content that kind of helped create a community around you and like a huge Twitter following as well. Would love to hear about the early days of building your brand in that space.
Sure. For me, it was unintentional because I have always been kind of a writer and, philosophical person. And I found myself struggling to, break into product with a non-technical background, teaching myself to code and earning the trust and respect of engineers and execs at early stage companies. So I wanted to really, selfishly start out just sharing these learnings as a way of processing the hardship. And I think, just philosophically, like success is oftentimes revisionist history, and there's a lot of privilege washing in how someone got from point A to point Z. And for me, writing has been a vehicle to kind of share the hard things in the trenches in real time. And that was kind of how I started building a community of other renegades, people who were, struggling to break into the Silicon Valley mold of success, not coming from the Ivies or Stanford CS degree, but rather kind of demonstrating themselves through substantive proof points, producing, products, as well as just being a substantive thinker overall. And that was kind of the angle in which I saw the world, and other people were, resonated with that. And in turn, I started building a community of first-time founders who oftentimes were former product managers. They were first-gen immigrants, as well as, underestimated founders. So people who didn't fall into those exact checkboxes other VCs were looking for. And through the course of, helping them with searching for that, elusive product market fit as a product leader, and helping them with the kind of early stage prototyping to build traction before they raise their first pre-seed round, I noticed, there is a market as well as an underground community of people who are told you're too early whenever they go pitch to VCs. And that too early feedback is oftentimes masqueraded or you don't check the box. So that community, started creating a virtuous cycle of us helping each other, and me bringing in other product people from, the Facebook RPM program that I graduated from, as well as expanding the angel network with other product execs in Silicon Valley, Austin, and New York. And that was just a really good way for us to kind of demonstrate, giving first and creating that karmic legacy of like, let's help each other in the trenches together before writing a first check. And it was actually through product advising that I was earning allocations in a lot of companies where they're like, we'd rather take a very small check from you, but have essentially a product advisor or executive on the board than to just take, a huge check from another VC fund. So I think that's kind of how things naturally grew. And over the course of my time, I've looked at different potential fund formations and realized, there's still a lot of various trade-offs in how you want to get started. And that has to be personalized to your own individual, risk appetite, the kind of baseline of where you started in life, as well as just your own financial security, which I, subscribe to a lot of the kind of, Warren Buffett line of thinking of like being able to make bets with what you have instead of going beyond that, risk appetite. So for me, it's more about the directionality of how I'm moving and investing than the speed in which I'm approaching it.
Cool. And thanks for calling out the trade-offs. We'll get into that in just a minute. Yeah. First, want to ask Ashley. Ashley, given your legal and real estate background, how did you convince the first few founders that you would be a good value add when taking your money?
Yeah, so great question. I mean, I find that it's really easy to kind of rule yourself out and think about all the things that you maybe don't bring to the table, particularly if you come from a non-traditional background, or like I said, you're not working in tech, if you don't have that kind of first degree of outreach, and you have to be realistic about what those limitations are. And you shouldn't be trying to sell people on skills that you don't have. Like, I'm not gonna, for the most part, unless it's something in those spaces, I'm not going to be able to necessarily help people, iterate on product or that kind of thing, which is obviously a tremendous value add. So you're thinking, okay, well, how do I compete? How do I bring value? But then that's where you have to be more charitable to yourself about the strengths that you do have. And then and then sometimes I'm finding in this space from a branding standpoint that the fitting out is not necessarily a bad thing. So I'm like, okay, like I'm in Florida, I'm in real estate, I'm a lawyer, I'm a woman, I'm a person of color. Meaning I am so far outside of kind of, the potential echo chambers that you are a part of. And I led with that kind of a lot in the beginning of, I am a lawyer by background, but a lot of my kind of day to day is more, kind of operational business side of things. I was like, I can bring to you a lot of times a perspective that is going to be markedly different from most of the people you're surrounding yourself with, just because of the diversity of my perspective from just being so far removed from that. And depending on the space that you're in, you might find that's fairly valuable. And that kind of became the initial individual kind of pitch. And in the meantime, I think there's something, kind of what Bo was alluding to, like this idea that you can build publicly. So, I'm not active on Twitter and social media, but in terms of like my AngelList profile and my LinkedIn and creating a website. And so I was able to invest passively a lot in the beginning through SPVs like AngelList, including, some of the alumni ones that you mentioned that have incredible venture-backed deals, and you learn to kind of cut your teeth, how to absorb that information, how to speak the language, and you start to network with those folks. So in the background, you can start to amass a pretty good portfolio, if you spend the time of good companies. And I was, amassing these companies, being public about my intention, being public about what I invested in. And so these things were kind of running parallel paths, and then eventually got to the point where it started to overlap, so that when I was speaking to founders, blah, 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 they go on my LinkedIn, they go to Google, they're like, oh, you're in that, you're in that, you're in that. And the thing about this business is signal can be very important, as much as, there's signal in the sense of like, a popular fund invests in a company and then all the investors herd to that company. I find that it also works the same way as an investor. I find that a lot of times founders will see other companies that I invested in, and that makes me attractive as an investor. And then, like I said, over time, like I said, in my situation in the beginning, a lot of it was passive investing. A lot of it was just me being aggressive in terms of outreach and kind of forcing my way into those rooms. But then over time, it can begin to switch. So then, like I said, I started to have this portfolio, started making these connections by joining these different communities, signing up for anything that's open application, where it wasn't, you just had to know. So it wasn't just about who you know, but where I could apply. I did it, and was fortunate to be accepted and started to build those communities. And now have kind of seen things switch. Now that I have the syndicate, and that's like, and that's public and AngelList, and I've been a part of these communities now, whereas like I said before, a lot of it was passive and kind of outreach. Now it's almost all inbound in terms of people who, oh, I heard about your syndicate, I came across your website, oh, I spoke with such and such founder that you funded, can you speak with me? Or founders themselves who I previously funded say, hey, founders tend to run in packs, hey, my such and such friend is doing this deal, do you want to speak to them? And you start to eventually see it start to switch once you finally push through.
Yep. And I love what you said about using your differences as a competitive advantage initially to stand out and kind of be able to build that brand, especially as the ecosystem of startups grows and like we get more and more different startups into the game. So thanks so much for sharing that. Let's talk a little bit about the structure all three of you chose. So all three of you started off as angel investors, but over time kind of specialized. Like Bo runs a community of angel investors now and like heavily supports that. Ashley focuses on syndicates, and Brianne's building her second fund now. So would love to kind of get a sense of like what are the top like one or two pros and cons for the chosen structure. Bo, it'd be awesome if you can start with angels.
Sure. So I think with angel investing, it's a pretty good way to test the waters. If you are interested in venture, it's quite forgiving in the sense that it's with your own money, which hurts, but also gives you less pressure, and kind of, you have to kind of, have shots on goals in order to continue doing it. So I kind of see it as a way of being able to set aside funds that you either, like feel comfortable potentially experimenting with, or using it as a way to network and meet other founders and other investors, everyone from angels to GPs. I think oftentimes, for people to approach angel investing, they do it from like a place of two perspectives. One is, this is a financial kind of gain, hoping that they're going to be able to build their own portfolio. The other is more around experimentation, learning, reputational, kind of growth. So I think from the standpoint of both, angel investing is a very low barrier to entry. It's more about gaining access to deals, as well as starting to build those relationships with other GPs within funds that I think give you a really rich cross-section of how institutional funds operate without going through the, kind of entire process of either recruiting or joining a fund and then realizing that's actually, not your kind of, MO of operating. So I kind of see it as a way to kind of learn from other people who are great operators, great founders, other GPs, being able to start cross-pollinating the ecosystem in terms of angels oftentimes do create that early signal and traction for other GPs within funds to start looking at a deal. And, in a way, you're kind of a maven in some sense, which creates a tipping point for a lot of these larger funds to pay attention. So I think there is a lot of, room to learn, as well as just like room to grow and experiment through this process that still feels quite low friction, as well as low commitment to, having to prove returns within a certain amount of, cycles of doing this.
Quick follow on there, Bo. There are often misconceptions around what it takes to become an angel investor. Would be awesome if you can kind of talk about like the kinds of check sizes you've seen for angels who are just getting started, especially with their own money. And secondly, like what are some of the legal things that that angel investors should possibly think about, if there are any?
For sure. I think, check sizes do vary a lot. And most people, I think, start out with very small check sizes, 5 to 10K checks, just to get those allocations early on. And oftentimes can negotiate down that minimum check size if they are hands-on angel investors that bring in, additional subject matter expertise or operating background. In terms of kind of the legality and checks and balances, I think you do have to, one, the accreditation process kind of sucks, honestly, of like having to meet these quite arbitrary standards. And now the SEC has changed the definition as if you take a FINRA test, you can prove yourself accredited through just knowledge-based understanding. So I think that is a huge improvement. And I hope that, direction in terms of democratizing angel investing to people who just have some capital instead of significant net worth lowers the gatekeeping nature of investing. Secondly, I think you do have to, if you're an existing founder or operator or even investor at a fund, you do have to check those potential conflict of interest. So make sure you talk to your general counsel at your company around, what is the process of having private equity holdings. For me, I have to file it where Samsung gets first right of refusal, since we are a CVC fund. So it's important for you to kind of, in a way, like sunlight disinfects everything. If you're going to be doing this on the side, make sure you do have those checks and balances in place so that you can do it in the long run without any potential legal implications or clawbacks.
Cool, thanks, Bo. Ashley, you started off also as an angel and then started investing through syndicates. Would love to hear the pros and cons of syndicates.
Yeah, so certainly there would be a lot of overlap with Bo on this one, and some of the pros are also it's double-edged sword. Also, some of the things that are kind of the biggest headaches, but in thinking about syndicating, you are unlike a fund. you are kind of singularly focused deal to deal. When I go to evaluate a deal, I don't have to think about what does that mean for kind of the larger ecosystems of companies or my fund. I don't have to think about I have to put in X capital, that I can't do it if I can't put in X capital, that I have to lead, that I have to do anything. I don't have to think about anything other than, do I like this deal, and do I believe in this company, and can I make a compelling case to my syndicate members? So from that standpoint, it can be really freeing in a way, and give you a lot of freedom to kind of really invest in things you like with no other consideration than the actual deal itself, and not kind of some of the bureaucratic things that might go into the fund side of things. And then also, like, you're still an angel, even though you have the angel syndicate, a lot of agility in the sense that you're going to be harmless to most people. So, for example, like me, like sometimes being able to come into things even a bit, later stage, just because I don't need to come in and mop up a huge allocation. You don't, but big fund's not going to see themselves as competitive, to me. I don't have any specific like I said, no specific mandates, don't need to lead around. And so, and I think have a lot more flexibility to get into different deals than you might sometimes with your fund, and you're, competing against other funds. And because you have the, subject to whoever you're using on your back end, have the ability to write smaller checks. Like sometimes there might only be room to put in, 80, 100,000, and you can do that as a syndicate lead. There's no, you're in charge of that. So those are, kind of all some of the pros of it. The downside of a syndicate is you do not have captive capital. So even if you have a lot of LPs, if you do it enough, you're usually kind of able to eyeball it and kind of get a feel based on, the metrics, co-investors, the sector, like what you might be able to raise, but you have no idea going into it what you're going to come out with. And that can be challenging for a couple of ways. One, you have to make the company, if they're not familiar with kind of how syndicates work, like comfortable with that ambiguity. You have to make a company comfortable with potentially a lot of people seeing their information. And that can work both ways, where sometimes I know I've done the diligence, I've seen the data room, so I know things about a company, but it's not things that they want, even though it's, it's not public in a sense. If a ton of people are looking at it, in a sense, it's public. And I can't always divulge to my syndicate members, specific things that they might want to know. And so there's kind of that tension. And like I said, and some folks are not going to want to deal with kind of like I said, the timing and maybe all of those different eyeballs looking at their deals. So there can be the disadvantages as well. Or you might be really excited about a deal and your syndicate is not. Or sometimes you might even, you end up self-selecting yourself out of deals because and which is why it's so good to be a true angel investor at core, because there have been deals where I'm like, I love this deal, I believe in it. If I put this out, everybody's going to be like, Ashley, what the hell are you thinking? Because it's just not kind of those like fastballs down the middle that they're used to. And in those situations, if I have high conviction, then I will just turn to my angel investor hat and I'll try to help them. Then that's maybe when I'll reach out to funds or other folks who can help them to kind of get it to the place that I need to be, where I know I'll be able, to syndicate. And then the other side of things, pros and cons on the economic side of things. So, pros are, your performance again is based on the individual investment. So you obviously have to be careful with the allure of using other people's money. But at the end of the day, you could syndicate 50 deals and your kind of return is only tied to the individual success of each deal. There's no hurdles to clear. There's no overall capital to return. So I guess there's a lot of interesting where people who would probably be bad fund managers could actually be good syndicate leads, because they could be lucky and one of those 49 deals could be bad and one is good, and that kind of make the returns make the returns for you. On the bad side of economics, I mean, I've not seen syndicates where there's any management fee up front, so it's all kind of success fee based. And if you're using something like AngelList, you at least need like some small skin in the game. So that can be challenging, economically and mentally, because you're doing it, you're grinding it, you're putting in this work, and you're not going to see anything unless there's ultimately some kind of liquidation event. And it just, like I said, it just kind of depends on your individual financial situation as compared to a fund where you've got that front end management fee going in on top of what might happen on the back end. But for me, syndicating has been a happy marriage, since I do things outside of angel investing, because my money that I make on the real estate side of things is effectively how I think of as my management fees that actually funds my life. And then I'm thinking of the potential upside, at least from angel investing, is what I potentially get through the syndication model.
Thanks, Ashley. Yeah, and Brianne, to wrap this up for the different structures, would love if you can talk about funds, the pros and cons of the funds, as well as how people should think about getting their first LPs on board, possibly beyond potential LPs that they've worked with. Like, how do they, what should they be looking for in LPs, and how should they make that outreach happen when setting up a fund?
Yeah, all really great questions. The path to raising a fund takes a little bit more time. I would say that LPs are looking for data points. And so data points typically come from a track record as an angel. LPs look for follow-on investors and the quality of the follow-on investors. And so, I love what Ashley is doing as far as, running a syndicate and doing SPVs. I think that's a great way to get started, where oftentimes LPs really respect that hustle, because one of the pros of having a fund is, I have my own fundraising that I go through, maybe, annually or, every 18 months. But once that capital is called, that's in the bank, and I don't have to consistently convince individual investors on whether or not they'd like to participate. And so I think the deal rigor and the persuasiveness required to consistently run SPVs is a really important muscle to build. And so LPs typically look for, how many SPVs have you set up? How many investors have you pulled into each syndicate, and, some of the angel investments that you've run. And so I think building as many data points as possible is a really effective way of building a track record to ultimately raise your own fund. When it comes to the actual, sourcing of LPs or thinking about LP construction, it really depends on the goal of what you'd like to achieve. What's awesome about the rise of operator angel funds or solo capitalists or all of these new models that are happening in venture, in the same way that AngelList and Carta are making it possible for individuals to raise funds, they're also making it possible for individuals to become LPs. And so I find that on the fundraising side of things, a great way to get started is to raise money from people that you've previously co-invested with, or finding individuals that are really plugged into the tech ecosystem that want to build a portfolio of emerging managers. In a lot of ways, I find those individuals can be the most helpful. You kind of get you get a really trusted relationship. Many of them are looking for deal flow, or they want opportunities to co-invest. You also have the benefit of individuals that are operators and have their own network and experience and ways that they can also help companies as well. And so one tangible example of that is I send a monthly LP update to all of my investors, and my LP updates look a lot like a startup monthly update as well, where I have asks above the fold, and I have quite a few very specific asks, because many of my investors are operators and they can open doors and be helpful for portfolio companies. And so I try to get as specific as possible and really ensure that anyone that's invested in the fund is also helping me help founders. And so I think that becomes an interesting model, where it's like the more asks you make, the more of a community you can build around a firm, which is really great. I find in the ecosystem today, and this is something for the emerging managers that are on the call, many LPs, they have their own strategy. And so a lot of the questions that I typically ask when talking to larger LPs are more around, how they think about their own portfolio construction. Would it be helpful for me to introduce other emerging managers? Would it be helpful to give them an opportunity to directly invest in a Worklife company at the next round? Many of them have kind of gone through their own evolution where they started out as primarily investing in other funds, but now they've reached an inflection point where they'd like to directly invest in companies. And so, I think it all comes down to really listening and understanding the goals of different LPs and finding ways to really collaborate, because, I think whether it's individuals who want to invest in emerging managers or larger LPs that want to build their own portfolio of funds, like, I just find that the ecosystem is really helpful. The more that you contribute and the more that you offer up introductions and find ways to work together.
Yep. On the flip side, Bo, you considered raising a fund and decided against that. Could you talk a little bit about the unit economics of like rolling fund and traditional fund? And Brianne, would love for you to contribute to that as well.
Sure. So I did look into different formation options and kind of did a cost benefit analysis for each one. I do have to preface, I think it has to depend on your own, again, financial situation, what your risk appetite is, and just function of who you are, where you were born, the networks that you're a part of. For me, I'm a first-gen immigrant, immigrated from China when I was 4. It's really important to continue to be in a position of financial security and freedom. So I evaluated these options in terms of, do I feel comfortable, either dipping into the red in order to raise a fund, or, do I want to continue kind of moonlighting days, nights, and weekends, to try to figure out what that long-term path looks like. I did look at the newer products within AngelList, so the rolling fund. I did look at the 506c traditional fund, which is an existing product on AngelList, but kind of more of a customization. And then I also looked at the traditional fund formation of going through, an LPA agreement with a law firm. So I think what I realized is there were trade-offs for everyone. It depends on your, oftentimes rolling funds are kind of easier to spin up. There's less of a cold start problem, and you're able to monetize off of your, network, your Twitter following, your content strategy, et cetera. But you do have to look into the different fee structures as well. So with rolling funds, there is, a quarterly fee that's $20K per quarter that you should be able to meet with a minimum of $250K raised per quarter to make that a cost, effective, trade-off and break even. For the traditional 506c, I think it's a little bit cheaper to start, and you can also use Carta as a form of the back office instead of AngelList running it. And then for the traditional fund, the spin up cost is going to be quite heavy. There are lawyers from Cooley quoting me everything from 100K to 200K, depending on which fancy schmancy law firm you talk to. So I think you do have to think about what is the ability of you to kind of either quit your job and do this full time and fundraise essentially, 6 to 18 to 24 months. Oftentimes that timeline depends based off of individual situation, but you're not going to be making revenue or income, until you do close that fund. And there are ways that I'm seeing emerging fund managers creatively, pipe their fees or take out loans or even sell a portion of their carry or their GP stake. For me, I think I just didn't feel like it was a good financial decision for me to kind of go in the red in order to create a fund without having what I call fuck you money, So it depends on each person's financial situation. And I think it's important to be honest about the unit economics of living off 2.5% fee of a small nano fund is going to be hard. Are you going to be okay with consulting and subsidizing that? And I think there is opportunity for LPs as well, to create a subsidy program where you are able to say, front load the 150K cost of starting a fund and have, additional carry to help enable these first-time fund managers that don't come from, family wealth and, huge IPO exits. But until that happens, I think it is going to kind of be a struggle to kind of moonlight and then slowly scale over time than it is to just quit cold turkey, quit your day job and just start fundraising full time.
One point on that, I think Bo brought up an amazing point, and it's something that I had learned very early on as an angel, and it's something that I'm really happy that I listened to an advisor about this. I think there's a common misconception, and especially as new angels, there's a desire to source companies. And this whole notion of sourcing companies is, investing in an idea that's pre-product, finding a great team. And one of the challenges with that when you're new to the investing world is that when you first start angel investing, every deck is awesome. Like, you're meeting really amazing entrepreneurs that are trying to change the world, that have a really great idea. But oftentimes it takes a while to really figure out, what companies are most likely to work. Or I think about this a lot, what is founder investor fit look like? To what extent am I able to really deliver a lot of value up front to build a great reputation as an investor and as an important name on the cap table, where founders feel like I'm delivering a lot of value, even if it's a really small check. And so one interesting piece of advice that I had got, I didn't know any VCs while I was really operating. I had asked someone at Zendesk, and then I spoke to the CEO at Zendesk and asked to meet some of our early angel investors. And so one of my mentors and now longtime friends was Christoph Jantz, who was the first check in Zendesk, and he's just known for being a really great SaaS investor. And so he had encouraged me to wait before writing my first check. And this has been a common practice for many general partners that join top tier firms, where you may wait 12 months before you write your first check. And the reason for that is you want to really get into a good cadence of looking at decks, analyzing business models, spending some time on really figuring out, like, what is your strike zone and where can you deliver a lot of value? Because if not, one of the misconceptions that can happen for new angel investors is like writing a large number of checks is actually a good thing to do. If anything, that's going to really, drain your bank account and potentially introduces a lot of personal risk. And so I oftentimes find to build a track record, especially if you're working at another startup or you are, networking and meeting other VCs, it's okay to invest in some later stage companies, or it's okay to write a 5K check in a company that has product market fit or that has already raised from a top tier VC if you want to start building a track record. I think it really comes down to finding ways where you can really deliver a lot of value. In Bo's case, if you have a known area of expertise, taking advisor shares to start can be really effective as well, where you can start advising companies, and maybe that's a monthly call, or maybe that's, a partnership with the founders or with their first product manager, or whatever it takes to be involved in that company can be really helpful, as opposed to necessarily writing a lot of checks fresh out of the gate in every company that you meet, just because from a financial point of view, when you go out to raise your first fund, LPs want to look at the quality of your angel portfolio. And so it's really helpful to wait and to be highly selective and build relationships so you can have access to companies that are raising larger rounds or that do have a product that's starting to break out.
Cool. As a follow-on to that, an audience question is, how do you think about ROI for your investments? And what is like a good return for like a seed or Series A investment for an angel or an early fund manager? Brianne, you want to start?
Sure. Yeah, great question. Yeah, I mean, I guess maybe this is a question for the group is, when you have an emerging fund, the challenging thing is that there aren't that many data points, especially for pre-seed and seed stage, and even for Series A. And so when you think about raising your next fund or raising future funds, Oftentimes there are a limited number of data points, and so LPs will look for, they'll look for markups, and so from the entry valuation when you invested, what is the company currently valued? Something that's more anecdotal or important is who are the investors that have followed on after the moment in time in which you invested, and so the quality of follow-on investors is actually really important to LPs. One of the interesting things that's happening right now in the ecosystem is that you have platforms like Sequoia, Andreessen, and firms that are both raising. They're now doing more seed investing. They're also raising growth funds, and so a lot of the LPs in Silicon Valley are doubling down and investing in their existing positions with other firms. And so what that means for emerging managers is you need to find your own differentiation, which can be really helpful as far as saying we have early access to companies that these firms are investing in. Sometimes that takes a little bit of time though to have some of those clear data points of the quality of your follow-on investors. But going back to my point earlier, if the plan is to build an institution and to start a new VC fund, then those are things that are really important. And so I actually found long before I started Worklife, I started attending VC events and just started getting to know as many other VCs as possible. Many of them were through cold emails. Some of them were through warm introductions and just asking my co-investors or founders that I've invested in if I could meet their lead investor. Just to start to build that network, because I do think it's helpful to really get into, to quote unquote, get into the flow. And so to really get a read on, these are companies that are starting to break out and trend well. These are and quite frankly, a lot of my early VC relationships came out of cold emails where I'd say, I really like your portfolio. I'm thinking about angel investing, or, I'm trying to figure out like, how did you get into these companies? And so I think that sort of level of respect and, sort of tracking who are the general partners at firms that they're in companies that you'd love to invest in at some point can be a really good use of time. Simply because in LPs do look for markups and they look for follow-on investors. And there's a lot of these more sort of anecdotal pieces of feedback that you get from LPs. And so in the same way that angel investors get FOMO about not investing in a certain company, LPs actually have that on the firm side as well. And so, once you start to build alliances and once you start to, get into a flow of co-investing with a certain class of people, then oftentimes those LP introductions can come from them as well.
Great. Bo, did you want to add anything to that? For ROI
sure.
for investments?
I think there's also a component instead of just looking at pure ROI of what is the kind of return on your own learning. I kind of see it as, I'm not a financial a financial investor, and my day job is very much looking at things from more of a strategic investment component. So I do like to look at like, how did I develop a worldview on, AI through the course of looking at these deals with other GPs. And to add to Brianne's point around forging those co-investment relationships, I think what GPs do add to your angel thinking is a certain level of analytical rigor that they are beholden to with fiduciary duty to their LPs. So I will, have my own memo or own framework for a deal, and what I'll share the deal with, say, Anne from Floodgate, and her entire team has a financial model and has done cohort analysis calls with the different users of this product. And, I had an inkling and a gut intuition about the company and the product and the market, but now I'm able to learn from these institutional partners, like what is that macro view and how do you reduce it into the numbers and nuts and bolts. And coming from product background, like financial modeling is new to me, but I'm very intellectually curious to understand how you can reduce things into value investing. So I think that is oftentimes what is not captured in just the markups and the ROIs. Just, did you develop a new subject matter expertise? Did you expand on a worldview? Did you develop a thesis in the course of running through the res of angel investing? And that can apply in a number of ways, you know, whether you go into a fund, you start your own fund, or you actually end up just like becoming a domain expert, you know, in your day job as a result of the investing. I think it's kind of a mini, you know, grad school crash course of sorts through angel investing.
Yeah. Cool. And then to wrap us up, Ashley, what is your one hypothesis for how VC will change in 2021 and 2022, given the rise of angels and micro VCs?
I think we've kind of started to allude to it, but I think one thing that we're going to see is definitely more competition earlier. And as Brianne was saying about some of these, you know, these big name funds that are now starting to look earlier stage, because it is kind of like Attack of the Rebel Fleet. I know on my side, I've seen like a massive proliferation of angel syndicates and people realizing that it's, you know, it's not like you could just go and snap your fingers and start one, but the barriers to entry in terms of angel investing and syndicating, at least compared to raising a fund, are not as high, and people kind of figuring out what their niche is, what their brand is, and a lot of people going for it. So I'm certainly starting to see like a mass proliferation. You even have things like there's this like Gen Z VC Slack where like, you know, Gen Z and, you know, 20-year-olds in college like getting into VC, and it's all pretty interesting stuff. So I think it's going to be a little frothy, a little bit more competitive, but I think there's going to be a lot of opportunities because I think it's also opening the minds of founders about how to get funded, particularly at that early stage where you are the most competitive and can add the most value. You know, some people have been through the rigors and they understand what's, you know, syndicating and whatever it is, but some have like, well, what's AngelList? Like, what's the syndicate? Oh, that's pretty cool. Or I can use that where I can maybe get a check in my hand as I'm like actually trying to do things that are meaningful and build out the project while I'm chasing, you know, some of these bigger funds. So yeah, I think that's the main thing that I'm seeing.
Awesome. And with that, we'll wrap up this session. Thank you so much to the panelists for being here and answering these questions. For all the attendees, Marian will be following up with the recording for the session and the social links for the speakers, so you can follow them and their journeys. Thanks so much for being part of this.
Yes, thank you, everyone. Such a pleasure. We will be sending out a survey, so please make sure to give us feedback. And thank you again for your time and all the speakers. Such a pleasure to learn from you all. Thank you again.
Bye.
And have a good one.